Good morning, everyone. My name is Jan van Eck. We're doing a webinar on allocating to Bitcoin. This is in the spirit of a quick, informal catch-up, a pulse taking on kind of where Bitcoin is and how we think about allocating to Bitcoin. A lot of questions amongst our clients arose as the price corrected from kind of 125 to 80, sort of what's going on. Do we still believe in it? What should we be looking at? So this webinar is attempting to answer that question. If you think that Bitcoin is rat poison, then save your time. This is not the webinar for you. This is the webinar of I'm thinking about adding it to our portfolio. I see it as legitimate, or I own it. How do I think about increasing or decreasing its weight in portfolios, and how we think about it. I'm joined by people who are much more talented and knowledgeable than I am. Matt Siegel, Director of Digital Asset Strategy at VanEck, active on Twitter, portfolio manager of our active ETF node in the space. And then Charlie Cameron and David Schassler, who sit with me on our multi-asset allocation committee. So we are making decisions on allocating to Bitcoin in a number of different strategies as appropriate. As promised, I'm going to try to keep this to about 15 minutes or so. I've been told that the way to ask questions is through, I guess, either chat or Q&A. So I'm just going to share some quick screens, and we will go through this. Okay, two major topic areas. I'm going to just sort of speak to how we think about allocating to Bitcoin from, I'll call it a fundamental basis. And then David Schassler will just talk about how we do it in our multi-asset strategies. So I guess what I mean by fundamentals is in 2017, we said, listen, Bitcoin is a store of asset that should be a part of your toolkit in allocating and creating your portfolio. What are the basics that we look at? And this discussion, I abbreviated as GEO. This is new as of last week, GEO, which I'll explain the three major components of how we think about allocating to Bitcoin from a just sort of what I call fundamental basis. So this came out of discussion with an investment committee for a top private bank. So as an audience I have in mind today, sort of if we were sitting around an investment committee, how do we underwrite investing in Bitcoin? So the three major topic areas that came out of the discussion are global liquidity, leverage in the crypto ecosystem, and on-chain fundamentals. These, I think, factors change in importance over time. And I'm going to just discuss them very quickly. Global liquidity is sort of the store of value aspect of Bitcoin, probably is more important when there's more liquidity in the world. I think I sort of wanted to come up with a bottom line, so I'll say global liquidity is kind of medium for Bitcoin right now. Then one of the maybe less important things, but still something that we look at is, how much hype or money is chasing around within the crypto ecosystem. Sometimes there's a lot of leverage within it chasing Bitcoin. Sometimes it seems like all the leverage has been squeezed out, like after the failure of FTX and some other big players in the ecosystem. I would say there's very little leverage in the ecosystem now. So that's kind of a positive sign for Bitcoin. And then the third category is sort of what's happening on chain, the Bitcoin fundamentals, the 4-year halving cycle we'll talk about, and that is bearish for Bitcoin right now, or bad. Okay, so just in thinking about these global liquidity or fundamental reasons to own Bitcoin, these big things haven't gone away. So people are worried about, should I sell all my Bitcoin as a thesis? Should it gone away? Should we not think about it? I think I want to remind people of these basic elements. So developed markets have countries, the US, Japan, Europe, have large fiscal deficits they're running and large debt to GDP ratios. They those concerns come in and out of the newspaper, but they're very global, as Charlie will remind us, and important. Secondly, and I think this has been driving demand for gold in a major way, is just that emerging market countries are continuing to demand an alternative to the US dollar. Gold has been the beneficiary of that this year, but I think Bitcoin is an indirect beneficiary. And the factoid I like to mention is India is going to, I think, within the next decade, become a fourth major consumer market. It's just another sign that the world's economy is fragmenting and the demand for decentralized stores of value like gold and Bitcoin are in a secular increase. And then, topical now for the December meeting, but also next year as the Fed chair rotates, is this issue of inflation risk in the U.S., which has not gone away. Okay, very quickly, here's just one chart on that issue of global liquidity. You can see while goods inflation has come down, services inflation is still lurking in the U.S. economy, and it's hard to say that the fight of inflation is over. About a month ago, Matt Siegel and I did a webinar, which I would call foundational, which goes through all these different fundamental signals. I'm not going to kind of go through that now. I would just say that Bitcoin has a strong correlation to, in particular, European money supply, number one, and then it does have the inverse correlation to the dollar. So sort of, again, that's why it's lumped together with gold. So that's the global sort of liquidity issue. So the G and Geo. So two charts on the ecosystem that were top of mind. So before we get to the ecosystem, or as we get there, I guess, this is a non-traditional ecosystem chart, but kind of half of Bitcoin trades over the counter, and it's not visible to every sort of person with a Yahoo Finance terminal exactly what I mean by liquidity within the ecosystem, because there is this offshore market. For example, there's a big decentralized exchange called Hyperliquid that a lot of people haven't even heard of. But in that offshore market, what I think is a strong signal, and there's a chart in Matt's webinar, is what's called perps funding rate. And what that basically means is the demand for money to make leveraged bets on Bitcoin. And there is a strong correlation between stronger demand for leverage for betting on Bitcoin and the price cycle. So that's leverage within the ecosystem. It can be also a warning sign as a contrary signal. And then the last thing I look at is just market makers of crypto, and market makers, a lot of them got very hurt during the kind of crypto crunch a couple of weeks ago, and they're probably still rebuilding their balance sheets, at least the ones we're talking to. So there's not a lot of leverage in the ecosystem, and here are some other charts that sort of would be bullish. So this is a new thing to look at, and Matt, I welcome any comments on this, but this is ETF inflows and the price chart of Bitcoin. And when you see this sort of the average cost of the ETFs fall below the current market price, that has bounced before. So if you look at these previous experiences, so I'm not sure Bitcoin ETF demand in the U.S. is fully determined, but it's certainly one thing one would look at as leverage within the ecosystem. A second phenomenon, a new phenomenon again of leverage within the crypto ecosystem, was this phenomenon that sort of started several years ago with Michael Saylor and Strategy, but then blossomed over the summer as many digital asset treasury companies listed, which in and of itself is sort of interesting. But more interesting is that those companies traded at a multiple, not just a large premium, but a multiple to the value of their underlying asset. So here you see this for Strategy, which again is the largest digital asset treasury company, if you want to call it that. And you can see it was trading at above 6 to 7 to 8 times the underlying value of its Bitcoin. That has fallen now to about 1 times market value. So to the extent that the premium was an example of the leverage or enthusiasm in the system. The leverage that's gone as well. So to me, that is also kind of bullish if you want to look at that second. So we've talked about G, global liquidity, E, ecosystem leverage or crypto ecosystem leverage. And then the last thing I wanted to talk about is the on-chain, the O in Geo. And so the big thing, I think, is just really obvious, but Bitcoin has had a halving cycle. The halving is when the rewards to Bitcoin miners fall in half. It's determined on the blockchain. Obviously, it's a decentralized software algorithm, and that is bearish for 2026. You'll see the chart in a second. Having said that, recent Bitcoin cycles have been muted, so Bitcoin has rallied less in this recent bull market than it has in prior bull markets. So maybe the correction will be less. So let's just look at those charts. There's a lot here, but effectively, if you just look at the bottom, I'll look at it from a negative perspective. Every 4 years, Bitcoin has corrected very significantly, and so it's approximately 2 calendar years after the halving, and that happens on basically a 4-year cadence. And so 2014, 2018, 2022, so 2026 would be the next year. We don't have that on here, but you can imagine as a theoretically negative year. Again, this is just calendar basis. It's very simplistic, but it's color coded, so I like it. So 2026 is an overhang for this halving cycle. Again, 2028 is literally when it would happen, when the Bitcoin miners would receive half of the number of Bitcoin for the same processing. This chart on the right here compares the current Bitcoin cycle, which is in green at the bottom, to prior cycles. And as I said, the appreciation of Bitcoin has been less than expected. I think, I certainly would have expected higher highs this year for Bitcoin than the 125 that it achieved. But you can see how prior cycles, the appreciation was much higher. And then this is my last chart. There are some discussion within crypto, whether that's technically the Bitcoin community or not, is I guess up for debate, and I've been criticized for calling it the Bitcoin community. But big Bitcoin holders like the Winklevoss twins have embraced a blockchain Zcash that has greater privacy. So that's one thing that's been in the ecosystem. And another concern is with the advance in quantum computing, does the privacy, so the encryption mechanism, for Bitcoin that's currently in place, does that need to be upgraded to make it quantum resistant? And so I'm just stating that listening to some of those conversations, that's what you hear. I guess there's always narratives in bear markets. So they may or may not matter, but I do think that the on-chain cycle, the 4-year halving, is one thing that investors need to be thinking about. And now I look forward to, since it's been less than 15 minutes on target, to answering questions. So I see a bunch of questions that were in chat. I don't know if David or Charlie want to help me out with the questions here. All right, I'll just start. So best thinking for investment allocation and use case at Square terminals. Matt, you want to speak to that?
Sure. So Square, ticker XYZ, that's Jack Dorsey's company, which has made markets in Bitcoin for many years. And in the last quarter, they've become more aggressive in making it easier for their merchant partners who use those white Square terminals to accept Bitcoin. There are tax considerations there. So there's new proposal in Congress to do a de minimis exemption for very small Bitcoin payments. Any legislation is kind of a high hurdle. So I do think that taxes, are one barrier towards a greater mass adoption. But it's been interesting to watch Square get more active in letting their merchants accept Bitcoin. And also Square has a new Bitcoin mining machine that is coming out this quarter. That market's been an oligopoly. One Asian company's been dominating it, and now there's more competition, partially because of the tariff, considerations here in the U.S. These machines are going to be made in North America. Um, so I think just like one of the questions in there, which I think is totally critical, what set of factors will convince you that the current sell-off is not a regular market correction, but a different state of the market, right? And
Yeah.
that's the big question, something we debated on the morning meeting this morning, where, Dave Schassler said sometimes the people who are closest to Bitcoin can become, the most negative. And, you just have to look at the data and say, when is mean reversion, likely to take place? So those set of factors for me, I'm looking at institutional and sovereign adoption, and that continues apace. We just saw Japan's largest regional utility has bought Bitcoin mining machines. France is increasing their adoption of state-directed Bitcoin mining. The Czech central bank buying Bitcoin. So that um, kind of legitimization of the asset class is continuing at the highest levels. And if that were not the case, I'd be more worried about the sell-off.
I mean, I guess I would answer that question in the following sense. What would convince me? I guess I don't look at market prices at all in a way when I look at the fundamentals. I look at, the VanEck macro view as what's the technology behind Bitcoin. So is there something happening to that technology or the network, I'll call it, that fundamentally undermines its thesis? So what are the fundamentals? Limited supply, right? I mean, it's hard to see, but one could see that the community would want to increase the Bitcoin supply. Number two, decentralization. What if it turned out like the ETFs completely ballooned in Michael Saylor and they owned half of the supply of Bitcoin? That would really make me uncomfortable. Again, it's something we track, but that would be worrisome. And then I would say that, quantum, I'm not saying it is a risk, but something like quantum that would crack the encryption of Bitcoin. And if the software that runs Bitcoin is, I call it upgraded, is not upgraded to make it quantum resistant, like that has got to be a major risk to whether you think about putting it in portfolios. And I would just take a step back. I don't expect every investor to be studying this kind of stuff. That's why VanEck puts a lot of its research on our website or talks about it in webinars like this. Our conclusions, I would say our fundamentals have not changed. But one can't be unwilling to question them. I think that's a really important part of what our approach is. Thanks for pivoting to that question. I think that's very on point, Matt. Whoa. I see a quiz. If you want to get rid of it, I guess you have to answer it. I'm not a financial. Oh, I can't answer it. So Matt, this may be a question for you. Is there a concern about the future performance, reliability, security if Bitcoin miners move operations to AI or HPC at a significant rate, particularly at the next halving event when rewards get cut in half, and potentially AI or HPC could be more rewarding?
Oh, I do think that
JP Morgan, sorry, just for the record, for people who can't see it, JP Morgan says Bitcoin needs to be over 90K for mining to be profitable.
yeah, if you include the depreciation, many of these miners are losing money. And I do think that um, the correction in the AI trade has exacerbated Bitcoin's downside, because the Bitcoin miners are generally sellers of Bitcoin every month. Right now, they're going through an upgrade process to repurpose many of their Bitcoin mining facilities to serve the AI and high performance computing market. That requires a lot of capex, which has been debt funded, and the more Bitcoin goes down, the more capital they need to fund these pivots, because Bitcoin has been the cash cow, so to speak. So if debt spreads are widening and Bitcoin's going down, that's a double whammy for Bitcoin miners. They were bigger sellers than usual in October. So I do think that has made Bitcoin a bit more cyclical. But that said, the way the Bitcoin algorithm works is that, if you leave it, someone else picks up your market share. And overall hash rate, meaning the amount of computing power that is contributed to the Bitcoin network, has basically been up only. There was a little bit of a dip over the last month, but generally the trend is up. So the market share that these pivoters seed will be picked up by others and presumably help their margins.
Yeah, I don't mean to be blasé about it, but Bitcoin's been through several halving cycles, so it's operated, and some of the flexibility and design of the network that Matt was talking to, China banned mining pretty much overnight, and so a whole bunch of miners were just taken offline, and the network was able to kind of pretty much operate without much of a hiccup. So I think that was a good real life test, besides the history of the happenings. There's a question, I think maybe just about the depth of the Bitcoin market. Effectively, it's sort of saying, can big holders who are known as whales, BlackRocks, or sovereigns crash the market and buy it lower? Um, um,
Well, I have one comment on that, which is, we had kind of a flash crash in October 11th, and liquidity did dry up quite a bit. So if we compare the top of book depth, just how much Bitcoin and Ethereum is there for sale or for purchase within 2% of the current spot, that depth of the market is still down about 30% from where it was pre-October. And I think that's consistent with the leverage that has really come out of the space. It's been a huge deleveraging month within crypto, and liquidity is pretty low right now.
But can individual actors or coordinated actors drive the price? And
I mean, Bitcoin trades at nearly 100 billion a day, so I would say no. But relative to where it was a month ago, it's easier.
right. And the market structure is not as mature, as, like, I'll call it a US ETF market structure. And so there are price sources or various kinds of things that can cause quote unquote glitches. And sometimes people try to take advantage of those. That's still an operating theory that some have, right? That's what happened in October, mini crash. But it's not generally true for Bitcoin as the largest and most liquid digital asset. So I would say very low on my list of concerns. I mean, something to watch, but probably unlikely. What are the use cases you have seen for Bitcoin in institutional portfolios? I tell you what I'm going to do is I'm going to bring David online because I realized that I skipped over some slides, but I'm going to smoothly recover and turn it over to you for a couple of minutes of commentary, David.
Sure. Yeah, definitely not trying to break the cadence here. I approach it from a different angle. And my angle is kind of really simple, is that I allocate across asset classes. So I don't have to be in Bitcoin. We're often in Bitcoin because it's an awesome tool as a capital allocator. If you give me something with a great long-term mean return and a lot of volatility, I'm going to say thank you, and I'm going to use it in a portfolio to make money. That's generally the setup on this. So I'm going to hold it all the time, and then I'm going to get excited about the extremes. So what do we do as investors? The way that we allocate capital, we ride momentum most of the time, right? That's the setup, because the market's efficient, but not perfectly efficient. So we want to ride that. And Jan set up earlier the structural reasons why we think Bitcoin is going to continue to perform over the medium and long term. And then you get into these extremes. That's what you're seeing here. So what you're seeing here is the red line, which is the Bitcoin price. And then you're seeing standard deviation brackets. And what you're seeing here is that this is a big correction. It's a big correction. So if we're sitting here now and we're looking at Bitcoin down over 30%, and it started correcting now in the beginning of October. So October 6th, we started correcting. We view Bitcoin as an early liquidity barometer. Jan, I think, very thoughtfully put a 3-point framework up to how to think about Bitcoin pricing. This is, you could use all the analogies that you want, the canary in the coal mine, the smoke alarm that's going off, et cetera. But it's clearly was an early warning indicator of risk. It started correcting well before the technology stock. So if we look at technology stock, QQQ, it's down about 5.5%. And that started correcting about 3 weeks after Bitcoin, right? Bitcoin doesn't have the classic financial fundamental looks, right? It doesn't have the valuation support that you'd see traditionally on an individual equity, cash flows, et cetera. So it trades basically based off of global liquidity and expectations of market risk. So you'll see it move quicker. Once you get to extremes like this, it creates an interesting opportunity. So we're buying Bitcoin, right? Full stop. Now, what does that mean and what does that not mean? That does not mean it's not going to go lower. And if it goes lower, we're going to buy more. We're not going to buy indefinitely. We're not going to keep buying over and over and over again, but we're going to structurally continue to buy as it falls within our framework. As long as we don't have too much exposure, we're going to take advantage of volatility, because volatility is your friend. So we're not saying it doesn't go lower, but here's what we are saying. We are saying in 6, 9, 12 months out, we feel very comfortable that these are going to look like very smart buys. And this panic and this sell-offs and the people that are closest to it thinking that, it's going to fall much, much further. Great, right? Because that's what creates the volatility. That's what creates the uncertainty. And that's what makes people not want to buy. And that's what causes these opportunities. So we're not going to be concerned about it. And the reason why we're not concerned about it is really, really simple. We're not overexposed. So if you're not overexposed, it's not driving our overall P&L. It's just a position in the portfolio.
David, can you just explain what you mean? Like for a moderate risk portfolio, how much Bitcoin do you own? 50%, 60%?
Generally, we want to be 2 to 3%. If you're a 60-40 investor, 2 to 3%. So, if we start the correction at, 2.2, 2.3, and then it sells down with the rest with Bitcoin, right, prices falling, and it ends up at 1.8, 1.9%, we're going to continue to top it up. And that's what we're doing. We're as it loses ground in our portfolio from an allocation perspective, as prices fall, we're then nibbling into it. And that's exactly what we're doing over and over and over again. So not stressed, because the position wasn't oversized going into it. And actually now volatility is our friend. So we're actually very much on the offensive, thinking about how do we set our portfolio up now for the next leg of gains that are going to come in the next 6, 9, 12 months out. And not stressed because we didn't go into it overexposed. And that's the setup. And that's what I hope that's the position I hope most people find themselves in during these corrections.
Can you just walk us through the slide really quickly?
Yeah. So what this is showing is just historically kind of how we trade Bitcoin within our all-in asset allocation portfolio. So at the bottom, you're seeing our Bitcoin typical ranges, and you're seeing for a moderate investor, we're just generally 2 to 3%. And because we started at 2.2, 2.3, and then it sold off, it got smaller and smaller and smaller because it was acting as a liquidity barometer, correcting significantly more than the other assets in the portfolio. Then we started going on the offensive and tactically increasing that position and taking advantage of volatility. And what you're seeing on the top is historical buys and sells that are basically based off of the same setup, where when prices shoot up a lot, we'll trim, we'll take profits. And when then prices correct, we'll take advantage of volatility. Now is certainly for us a take advantage of volatility time. Not saying, again, it's not going lower, but if it goes lower, we're going to buy more because we're not outside of our ranges.
Great. And do you hide this information, or do you share it somewhere?
It's available. So if you're an investor in our model portfolios, you're going to get the updates. We write commentaries. We're talking about it all the time. In the last month's commentary, we were talking about opportunities coming. We think opportunities are here. And we expect, as long as prices stay weak, we're going to continue to buy within reason. And if they don't and they catapult higher from here, we're going to make money. And that's the setup.
So we have a very disciplined process that David just talked about, but we do get questions even in the Q&A here, and in conversations with clients of when do I buy, like what prices, how low can it go, and everything. So this is only as a reference point, but we put together a slide here. Sorry, here we go, of different what sort of almost ways to think about what the price might be. And I guess when we put this together at the end of last week, it was sort of like around 81,000, and now it's higher, but who knows? As David said, where and how long this cycle could be. So I just would flag maybe two, which was the 77K mark, which is before I said that this cycle has been more muted. So if you took the last cycle drawdown and cut it in half because this cycle has not gone up as much, that would be around 77,000. And a lot of people have pivoted towards the middle point of 55,000, which is its 200-week moving average. I would point out, since Bitcoin has been going up over time, that moving average will also increase over the upcoming months. So, all right, David, any final comments before we get back to questions?
Yeah, don't try and call bottoms. Don't be too cute with it. Take advantage of volatility. The volatility is your friend. It's a feature. And if you're buying when everybody else is panicking and running out the door, you're generally doing the right thing within reason, as long as you're not overexposed.
So we have a question. What use cases have you seen for Bitcoin in institutional portfolios? For investors without a dedicated allocation to digital assets, where would it fit in the portfolio? Anyone want to pick that up?
Bitcoin's its own asset class, in our opinion, or digital assets are their own asset class. New asset classes aren't born every day. This is the first new asset class we've had in our lifetimes. So if you're listening on this call, this is the first new asset class, right? We've got stocks. We've always had stocks. We've always had bonds. We've had real assets. Now you've got digital assets. It's its own thing. Some people call it other, whatever you want to call it's fine, but it doesn't fit within the others. And for us, the answer is not zero. So if your answer is zero right now in your asset allocation, make it 1%, get more comfortable with it. But we think it's totally reasonable to have 0 to 3% within an all-in asset allocation, regardless if you're institutional or retail.
I mean, I would say that gold and Bitcoin are in the same category as store of value investments. And we started in our quarterly outlooks getting more enthusiastic in the spring of 2023. Again, at that point, the Fed had just raised rates a lot, and we said, listen, cycle's not going to get tighter. Global liquidity is not going to get tighter from here. So that was a good entry point. Again, with in mind, trying to answer this investor who had, let's say, started from zero. In my mind, I think this is kind of a 10-year thing that you want to have, because these issue of budget deficits and high debt in developed markets is just not going away. And what else do you have in your portfolio to protect you against those? I would say if you don't have gold or Bitcoin, I think you're exposing your portfolio to a systemic risk without any protection. I mean, that's just our view. So that's how you get from zero to something in your portfolio, and then it's just a question of how do you size it. But that's a discussion that I'm happy to have over and over again. How does Bitcoin, David? I'll direct this to you. Fit with gold as a hedge?
I like the way you just said everything that you just said. So we are strong proponents of the idea that debt matters, deficits matter, and the future is pretty clearly mapped out as it relates to both those things and the risks that they pose to portfolios. So if you look at your asset allocation, you don't own gold, you don't own Bitcoin. I think that's a problem. It's a huge risk you don't have in your portfolio. So that's the way that I tee it up. That's the way I frame it up.
How do you think about allocating? So we talk about dollar cost averaging, right? You're kind of using price signals to allocate. I guess if someone's not using your methodology for allocation, right, how do they think about allocating through bull and bear markets? I mean, I guess the answer would be use your methodology, right? Because you gotta take profits, right, in bull markets. right? To give yourself a risk budget to dollar cost average in bear markets. I guess there's no other way of saying that, right?
You've got to start with the sizing it. So size it appropriately. The tail can't wag the dog. You don't want your P&L to be dictated based off the price of any individual asset, much less Bitcoin. So I would say start by sizing it the right way. And then once you size it the right way, you have to ring the register when you're making a ton of money relative to other asset classes. So don't be shy about trimming gains. And alternatively, that sets you up perfectly to buy during periods that exactly look like this. So it's discipline. And here's the thing, I said this before. If it feels bad when you're doing it, which is you're selling the thing that's working the best in your portfolio, or you're buying the thing that nobody else wants to, you're on the right track.
David, you talked about 2 to 3% in Bitcoin for a moderate portfolio. How'd you come up with that?
Contribution to volatility, contribution to risk. So what we're doing is we're looking at the total volatility, the total risk of our portfolio, and then the sources of volatility. So if you're an asset without a lot of volatility, you're going to have a higher weighting within our portfolio. And if you're an asset with a lot of volatility, that means you're a very efficient asset that we can allocate a small amount to and get a pronounced impact within our portfolio. So what we do is we back into it given the historical risk and return attributes of each asset. So when I do that, I step back into a range for an asset for a general investor that's a 60-40 of 2 to 3%. And it used to be lower, but Bitcoin's maturing. And as it matures, the volatility profile and the risk attributes are maturing as well, demanding more market share within your portfolio. And the hope would be that it continues to mature. And when we're having this webinar 2 years from now, 3 years from now, we're talking 3 to 5. And I think that is exactly what's going to happen.
If you're 2 to 3 for Bitcoin, what would you be for gold in that similar moderate risk portfolio? And where are you taking the Bitcoin allocation from a 60-40 zero allocation?
Yeah, so two very different questions. The first thing, if you look at your portfolio and you don't see a Bitcoin exposure of at least 2% and you don't see a gold exposure of at least 5%, I'd rethink that. So gold, I don't want to see you have less than 5%, and I really don't want to see you have less than 2% in Bitcoin for a moderate risk investor, because I think that that's really the minimal sweet spot to benefit from these assets. Secondarily, we're matching volatility. So we're funding our Bitcoin exposure from our highly volatile equity segment. And that's what we're doing. So we want to make sure our total aggregate risk doesn't blow out because we're going to allocate to a different asset. So we're going to match vol to vol, and we're going to fund it from our growth-oriented equities and give it to our Bitcoin allocation. Gold's a bit different because gold is a store of value, safe haven asset. Although the volatility is significantly higher than that of fixed income, because of the risk-off attributes that gold still has and the differentiation vis-a-vis correlation benefits, we are funding that from fixed income. And in aggregate, we're keeping our overall portfolio volatility level the same of that of a general 60-40.
Okay, just to remind everyone, please, if you have a question, put it in the Q&A or in chat. I'm going to try to capture everything. Isn't quantum a risk for everything, not just crypto? Why is it, a particular risk for crypto? Let me take a stab at that. Basically, a centralized system, like a Chase, like any major bank, has a chief technical officer that can deploy some quantum resistant code pretty quickly across that organization. Bitcoin requires the consensus of the community sort of to vote on that or to approve that, I call it again, software upgrade. So that's the risk, that it takes the community too long to do it, as opposed to an overnight fix, theoretically, that a bank could do. So yes, absolutely, the risk is generalized. And the reason people are worrying about it a little bit ahead of time, I think, in the Bitcoin community is just they want to make sure the community has enough time to both propose and then adopt that. And there's also a risk that not everyone adopts, I'll call it the latest version of the software to protect themselves. And so that's sort of like a residual risk, right? There's the risk of the Bitcoin we own or hold or custody, and then there's the risk of those who haven't upgraded their software and remain more vulnerable to quantum. But Matt, tell me if I'm missing something.
I think that was a great summary. I would highlight that the solutions around quantum could seem divisive to an outsider as the community begins to debate the Bitcoin improvement proposals that will kind of consolidate the community's viewpoint. But I would remind folks, 10 years ago, Bitcoin had something called the block size wars, where there were two very opposed communities, one who wanted to increase the data throughput of the Bitcoin blockchain and one who didn't. And it became a real civil war that if you would have thought Bitcoin was selling off during the block size wars, but it had its most explosive returns as the community grappled around the really tough questions. So it's the type of wall of worry, I think, concern that can accompany a bull market. But in some of our crypto-only strategies like Node, we did add a position in VanEck quantum computing ETF, a small position, but as a hedge on this resolution being a bit more disorderly.
Charlie, do you have any comments? I haven't called on you.
Oh, I see there's a question about liquidity, and to me, I think the peak of liquidity or the tightening is done now. I mean, if you see fiscally, Japan is blowing out their budget again. Germany's going to have more fiscal spending. China still has to address their real estate problem. The U.S. has improved, but we still have a lot of debt and deficits. And rate cuts, if you look, we have two major crises this century, right? So the financial crisis in '08, rate cuts peaked in August of 2010. There were 313 rate cuts from more than 100 central banks. During COVID, the amount of rate cuts peaked in November of 20. There were 255 rate cuts. We are now, in this cycle, we are up to 316 rate cuts so far. So that's without the Fed cutting more. You're going to get more from the Bank of England. You're getting more rate cuts. So there has been a lot of liquidity added into the system. So if liquidity is important for Bitcoin, we're getting it.
It's a slow moving signal, right? In a way, like we could be here a year from now and, having
Right.
more cuts under our belt, and kind of being in the same spot.
Yeah, monetary stimulus, they always say, is what, 12 to 18-month lag. I mean, it's maybe a little faster nowadays, but it's still there. It didn't
Yeah.
go away.
Got it. That's great. Okay, I have a little bit of a non-Bitcoin question for Matt, on digital asset treasury companies, in particular strategy, which I guess relates to Bitcoin, but any thoughts on that?
The most recent underperformance from MicroStrategy is driven by news that MSCI, the index provider, is responding to client feedback and considering dropping MicroStrategy from its indices. There's a couple $1 billion worth of passive money invested in strategy via those indices. So we've been cautious on this space because we saw from the last cycle that leverage and Bitcoin tend to not go so well together. So our steady state is an underweight in levered entities like MicroStrategy. But as you showed in your chart now, the valuations have come down quite a bit, and there's a number of the smaller cap digital asset treasury companies that are now beginning to sell their crypto and buy back shares, and that may put a floor under valuation. So it's a spot that we don't love structurally, but the valuations are becoming more attractive with many trading below their net asset value.
Okay, I'm gonna wrap up, and I just want to refer to two slides. Sort of one is just this what I call the sort of fundamental drivers or things, the buckets of inputs that we think about, I guess. One is global liquidity, and then we look at leverage within the ecosystem. So ecosystem leverage, that's very low right now. And then the on-chain fundamentals, really the halving cycle is probably top of mind for me. And we're coming into a year which has traditionally not been good for Bitcoin. Again, every cycle is different, as some of the questions have pointed out. So these are just, I think, if you don't have a lot of information on E or O, please do refer to the VanEck.com. We do write about ecosystem leverage monthly, and we try to talk about what we see going on chain every in quarterly webinars and other kinds of blogs and things like that. You can also subscribe to emails that address this topic on a regular basis. And then I wanted to refer to a less generalized view and point out that for our own portfolios, we use a very strict methodology in terms of adjusting the size of our allocation to Bitcoin in the portfolios where it's included. So I will wrap it up. Thank everyone for attending, and Charlie, David, and Matt, appreciate your ongoing contributions, and thank everyone for attending.